Okay, so we'll pick up this video from chapter 6 at this slide right here talking about cash receipts by mail. And this is easy stuff to read. Preferably two people are assigned to the task of opening the mail. That's so we have more than one person accounting for what's in the mail. The cashier deposits the money into a bank, and the record keeper records the amounts received in the county record. So everybody's doing something different. But when we receive cash, that's the process that should be followed so we can have good internal controls regarding our cash that we receive by mail. Control of cash disbursements. It talks about the keys to controlling cash disbursements and one not to require all expenditures to be made by check. That way we have a record of all disbursements. We pay by cash and we have no proof. So using checks allows us to go back and reference those checks that were used for certain cash disbursements. Limit the access to checks except for those who have authority to sign the checks, basically saying if you don't have authority, you shouldn't have access to the checks. So if we have multiple people able to gain access to the checks, then that's not implementing proper internal controls because more than the people that are needed to have access to the checks have access. So we want to limit that access to those that have authority. Voucher system of control basically establishes procedures for verifying, approving, and recording obligations for eventual cash disbursements. So we have a voucher, then we know we can go to that voucher, which should match up with those disbursements. Issuing checks for payments of verified, approved, and recorded obligations. So the voucher system allows us to keep track of those checks that have been issued, and the proof that the money went to the proper individual is going to be the use of the voucher system. Here's a voucher system. Look at a voucher system. So the sender has money goes from the cashier to the supplier. So if we're trying to pay a supplier for money that we owe the supplier, then the cashier is going to send that check over to the supplier, and they will receive that check. The accounting department, that information goes to the cashier. And when we're talking about the sender receiving a receiving report, that information goes to the accounting requesting and purchasing of the receivers. The supplier and vendor information goes to the accounting records of the receiver. Purchasing takes a purchase order, and that information goes over to the receiver supplier requesting, receiving, and accounting. And then the sender, when they're making a request, a purchase requisition, that information goes to the receiver as purchasing and accounting records. There's a need to know. It says a good system of internal control for cash provides adequate procedures for protecting both cash receipts and cash disbursements. Which of the following statements are true regarding the control of cash receipts and disbursements? First one says over-the-counter cash receipts from sales should be recorded on a cash register at the time of each sale. Second one says custody over cash should be separate from the record keeping of cash. The third one states that for control of cash receipts that arrive through the mail, two people should be assigned the task of and be present for the opening the mail. Fourth one says that one key to controlling cash disbursements is to require that no expenditures be made by check. Instead, all expenditures should be made by petty cash. And the last one says a voucher system of control should be applied only to purchases of inventory and never to other expenditures. So I'm already seeing two of those that are no-goes, the 4 and the 5. Let's talk about the first one. Over-the-counter cash receipts from sale should be recorded on a cash register at the time of sale. Yep, I'm going to say true with that. Custody of cash over should be separate from record keeping. Of course, that's true because we want segregation. We don't want the same person saying, okay, we've got $50 in cash, and then that person has the $50. They could be lying. They could say it's $50 and it's really $100. They just pocket the rest. So we definitely don't want the same person recording and having custody of the cash. For control of cash receipts that arrive through the mail, We talked about that before, having two people verify what's in the mail. And then I mentioned that the last two were false. We definitely don't want um, disbursements to be made by cash because we have no record keeping of that unless it's a very small amount. And then the voucher system of control should be applied to everything, not just purchases, but also to payments as well. Petty cash system of control, basically small payments required in most companies for items such as postage, courier fees, repairs, and supplies. And when you're operating a petty cash fund, you just debit the petty cash for the amount that you want in the fund and then credit the cash because that cash is going out of your main account into the petty cash account. And here's a summary of a petty cash receipts on the 27th. There was tile cleaning. That was an expense, $46.50. Merchandise was purchased of $15.05. For the transportation, that's what we paid, $15.05 for that. Delivery expense was a customer's package was delivered. That cost us $5. And then also office supplies. You get office supplies, we paid $4.75. So a total of $71.30. Just little small things that we spend money on just in the nature of operating our business. So not a huge account or anything, just petty cash. Cash we got laying around that we use for small things like this. Reimbursements of the petty cash fund says the cash payments report is used in making the journal entry to reimburse the fund. Debit each of the expenses and credit the cash. So we have all of these expenses. We know we debit expenses. Expenses are always debited, and we're gonna credit the cash for the amount of all of those expenses total. So here you see we have miscellaneous, merchandise inventory, delivery expense, and office supplies. And then the actual cash, which totals the amount of those supplies, is credited for $71.30. To increase or decrease the petty cash fund, let's look at the increase first. Petty cash, we talked about it being debited for the amount of cash that we're putting into the fund, and then we credit the cash going out. And to decrease the fund, then we go ahead and put cash in our main account and take that cash out of the petty cash account. So if we have money in the petty cash account that we want to subtract or deduct from that account, then we just put it back into our main account and credit the petty cash fund. Example of a cash over and short. If petty cashier fails to obtain a receipt for payment or overpays an amount, cash over or short will result. Petty cash payments report plus cash left in the account will not total the fund balance. The difference is debited if short to cash over and short, and the difference is credited if over to cash over and short. So let's look at this situation right here. We have a miscellaneous expense of $178. But we actually spent $185 cash. So we have an expense of $7 that we actually paid more than what we're recording. So $7 of cash went out, but where to? So we have an over of cash of $7 because we actually spent 178, but we recorded that 185 went out. So there's a problem. Here's a need to know. The Bacardi Company established a $150 petty cash fund with M&M as the petty cashier. When the fund balance reached $19 cash, M&M prepared a petty cash payment report, which follows. Here are the different receipts numbers, the account charge, who approved them, and who received. Total of $120 was approved And what we want to do is identify 4 internal control weaknesses from the payment report. So we're looking, first of all, I see no one approved the receipt number on number 16. That hasn't been approved. That's a problem. I'm looking at that. I also see that we don't have an account listed for number 15. And let me see, do I see anything else on there so far? Let's see what we got. Okay, so petty cash ticket number 14 is missing, right? So we went from 12, 13 to 15. So number 14 is missing. All petty cash tickets should be pre-numbered and all numbers should be accounted for. So 14 should be accounted for and it's not in this situation. Since the total cash on hand is only $19, $131 has been withdrawn, $150 minus $19. So only $120 in expenses has been documented. Management should investigate the $11 cash shortage. Petty cashier did not sign petty cash receipt number 16, like I mentioned. And we want to know, was the expense approved or was it just an oversight? And then petty cash number 15, it does not indicate the account to be charged. So if possible, management should determine the correct amount. If impossible, miscellaneous expense should be charged for that difference. So as we can see, all petty cash transactions should be accounted for, and if for whatever reason they're not accounted for properly, we got to identify what's missing and fix it. Another need to know, same information. Here it says prepare journal entries to record the establishment of the fund and the reimbursement of the fund. So if we're going to establish the fund, then we have to have a debit to a petty cash fund, and then we're going to have a credit to cash. So a petty cash fund of $150, and then we're going to credit cash for $150. Then when we reimburse the fund, we're going to take all of those expenses that were expended and total those up and credit our cash for that amount. Same information here. Just need to know, it says, what is the petty cash account balance immediately before reimbursement? And then what about immediately after reimbursement? So before reimbursement, it's $150, and then after reimbursement, it should be $150 as well. Okay. Notice it says the balance in the petty cash remains constant unless the amount of the fund is changed. Basic bank services, they have signature cards, deposit tickets, bank statements, electronic funds transfers, checks, and bank accounts. Here's a bank statement, has a company's name, address, the date of the statement, the account number, and all of the checks and debits and the deposits and credits that went on with that particular account. As you can see, you have a current balance, total deposit and credit balance, total checks and debits, and then the previous balance. Okay, so we take our previous balance and then take the total checks and debits and the deposits and credits into account. It should give us our current balance. As you can see, it says usually once a month the bank sends each depositor a bank statement showing the activity in the account. Now we're getting into bank reconciliations. And with bank reconciliation, it's prepared periodically to explain the difference between cash reported on the bank statement and the cash balance on the company's books. So the bank is going to have a balance, the books are going to have a balance. What we need to do is reconcile so we can have the same balance on the book that's in the bank. And as you can see from this particular slide, when we're talking about the bank balance, the bank statements, your deposits and your credits, your checks and debits, then you're going to have a balance. For the bank, you start with the bank balance, add and deduct timing differences as well as any errors, and then you'll have your adjusted bank balance. And for the book, it's the same thing. You add and deduct any timing differences and then correct any errors, and you have your adjusted book balance. And for the book balance, start the cash account and all your cash receipts and your cash disbursements going out, and you should have a balance. So as you see with the book balance, you've got debits and credits. Over at the bank, we're just adding to get our final balance. we'll get more into bank reconciliations in the next video.